In this presentation, I'll briefly go over an introduction to securitization and then show an example on how securitization can be used to fund cures for cancer. So if you're interested in funding cures for cancer, you can skip ahead to an example here and go down and go through the example. However, if you'd like to see a brief introduction to securitization prior to the example, we'll do that now. So what we're going to do in this presentation, what should make sense is how securitization is going to make financing assets cheaper and how it's going to allow us to finance some assets that we otherwise wouldn't be able to finance. That's the case in terms of funding cancer research. So, but at the end of the day, everything we talk about here goes to the core benefit of securitization, which means you as an individual or you as a business owner, it's easier for you to finance your investments, your business, your house, and so forth. So what we mean by securitization is this is a transformation of a set of illiquid assets into a tradable portfolio of these assets. And this is we'll talk about the benefits of this, but the idea here, in a classic example of this is mortgage loans. Prior to securitization, a bank would hold a mortgage loan on its books, which, you would go to your local bank, it would be funded by depositors in your area, and the bank would issue that mortgage and then hold it as an asset. However, what securitization allows is the bank to say, okay, well, and the bank wasn't able to, it would be very difficult for the bank to transfer that mortgage to another bank. It would, the transaction costs would be large. But what's going to happen with securitization is the bank can originate that mortgage and it can put it into a tradable portfolio. And then this can be easily transferred among investors. And so what this does is it takes these assets and makes them liquid. And of course, this is one source of the lower yield. So what can we securitize? In general, any asset which generates a stream of cash flows, we can securitize. So famously, we've securitized music royalties. So the idea is if Elvis is still selling records and we can estimate the cash flow that's going to generate, theoretically we can put that into a securitization. But generally what we securitize are mortgage loans, auto loans, credit card receivables. But anything that where we can statistically describe the cash flows importantly, that we can transfer. So part of the securitization is the ownership of it has to be transferable. So as long as we can transfer the ownership and describe the cash flow statistically, it's a candidate for securitization. Assets are more appropriate for securitization if they provide diversification. We'll talk about this quite a bit. But so we have already talked about one source of how securitization lowers funding costs. That's through making an illiquid asset, which would require a higher yield, making it liquid, which requires a lower yield. But also one of the important factors here is diversification. That takes a set of assets, and it, the average, as we diversify, the average expected return doesn't change, but the risk gets lower. So this lower risk is another source of lowering the yield, the funding costs. It's generally best if there's a large number of assets. This goes into diversification. Also, a component, extraordinarily important component of diversification is the correlation. The correlation structure among the assets in the securitization is going to tell us how much benefit we're going to get from securitization. That's why I say correlation here is key. Again, if the correlation was 1 among all the assets, there would be no benefit from diversification. The lower the correlation, the greater benefit we're going to get. So understanding this correlation structure is very important. And if we can't estimate it, then it becomes harder to securitize the set of assets. So why securitize assets? So here we'll briefly talk about why it lowers funding costs. But so one, diversification, like we talked about, that instead of holding one mortgage loan, right? If I hold a package of them, I have the same expected return but with lower risk. Financial engineering. So the idea here is once we have a package of securities, we'll be able to structure I can allow you to buy a specific tranche of that security. And this gives you a risk return profile that you couldn't get by just holding the individual asset. So without the securitization, you couldn't get this risk return profile. We'll talk a little bit about tranching later. Increased liquidity, like we've talked about. Lowers transaction costs in the secondary market. This again goes to the increased liquidity. So the idea here, it's key to understand that once we've securitized these assets, they go from being illiquid to very easy to transfer in the secondary market. Extraordinarily important here is securitization allows an easy mechanism for moving assets off a firm's balance sheet. So the idea here is if a bank needs to free up their balance sheet, they can easily they can take all the mortgage, a bunch of mortgage assets that they hold, and they can securitize them and move them off their balance sheet in return for cash. So if it makes it much easier for a bank to, originate mortgages, it makes it, because the bank knows that they don't have to hold them, and they can move them off their balance sheet in exchange for cash anytime they want. It means that they can fund with lower funding costs. So again, lowers funding costs. Importantly, separates the credit rating of the originator from the security. So the idea here is I don't have to worry so much about the credit rating of the originator, because the security can be moved off their balance sheet very easily. Facilitates geographic dispersion of funding. This revolutionized, of course, the mortgage market. If you remember, the 1960s, again, as I mentioned, if you wanted to get a mortgage, you go to your local bank, and then your mortgage was funded by depositors in your area. So if people weren't saving a lot, if there weren't a lot of depositors in your area, it was harder to get funding. However, now funding for mortgages is a global, right? The funding for your mortgage may come from Japan, overseas. The idea here is if I want a mortgage, I'm in New York, I'm not constrained to the depositors around me in New York. The funding can come from anywhere, and this is, and again, because of the diversification, investors abroad may be willing to fund these very cheaply, much more cheaply than my neighbor in New York, because again, funding across borders can lower correlations. So also, issuers of securitizations can tailor the maturity yield and seniority to suit investor preference. So this goes to the tranching and the financial engineering. But once we securitize assets, we can try to structure them to meet investor preferences that are prevailing in the market at any point in time. So this is just a brief, refresher on diversification. But one of the big sources of lower yield in a securitization comes from diversification. And the idea here, if this is mortgage one and this is mortgage two, if they're perfectly correlated, one defaults, the other defaults, right? Then there's really no benefit from diversification. This is standard deviation and this is expected return, right? So this would just be a weighted average of the standard deviations between the two assets. But as correlations get lower and lower and lower, right, we get more of a diversification benefit. And what we see here is by adding a portfolio of asset 1 and 2, we can get a standard deviation which is lower than either asset 1 or 2, which would be right here, right? So we can get a roughly 9% return with a 10% standard deviation. So as the correlation gets lower and lower and lower, this gets better and better, right? So the idea here is now we can have a 10% expected return with a 7% roughly standard deviation. So this correlation structure really affects securitization. So if we can put in assets which have lower correlations, then the securitization has a greater benefit and ultimately lower funding costs. So if I can find something that has a very low correlation with mortgages, put it in a security or a negative correlation with mortgages, put it in a security with mortgages, then I can lower both that security and mortgages' overall funding costs. Good. Background and history, briefly run through this, but pre-1970s, there was really no securitization. In the 1970s, Ginnie Mae, Fannie Mae, Freddie Mac started providing guarantees on mortgage pass-through securities. And then in 83, Fannie Mae issued the first CMO, which addressed prepayment risk. One of the problems getting the securitization market going was investors didn't like the prepayment risk in mortgages, which means this is the risk that interest rates go down and you refinance your mortgage. So I, as the mortgage holder, get my money back and have to reinvest at low rates. But they started issuing CMOs, which have different tranches. We'll talk about this by order of payment, and this allowed investors to sort of choose the prepayment risk they wanted. 1985, we get asset-backed security offerings. Today, it's common to securitize auto loans, credit card receivables, student loans. Yeah, I should have mentioned student loans earlier. Entertainment royalties, home equity loans, among other assets. Annual issuance of securitizations is in the trillions of dollars. And here's a link to a good report by Moody's. Securitization finances 30% of U.S. capital market funding and 40% historically. Now, one thing here to kind of test if test your knowledge thus far, you could say, well, 30% is large, 40%, these are large. This is trillions of dollars. But you might say, well, if securitization is so great, why aren't 100%? Why isn't 100% securitized? So I don't know. If you want to think about that before I tell you, pause this. But I'll tell you now. One thing to keep in mind is there are some securities which they don't need the benefit of securitization, meaning very safe securities. So treasury bonds, bonds issued by Apple, right? These are extraordinarily safe. The yields are as low as they can get. So the idea here is they don't benefit from securitization, so they're not securitized. But any sort of risky security, and particularly a mortgage loan would be a risky security, right? They tend to be securitized. Good. Steps in the securitization process, particularly, for my students, I don't. This is not something I test you on, but this is, as a student, I think, hopefully this will motivate you. What I want you to see here is how many people are involved in the securitization process, because there's a lot of jobs here. So this is just to give you an idea of the industry that's built around securitization. So the idea is assets are created. This means originated. So you have mortgage originators, auto loan originators. A special purpose vehicle is created to transfer the ownership. So the originator transferred the ownership to the special purpose vehicle. So you have people that run the special purpose vehicle. A claim structure, credit enhancements are added to the cash flows. So we'll talk a little bit more about this, but this is where some of the investment banking comes in. The SPV issues these claims that are claims against the particular structure as securities, and then we have credit rating agencies, NRO, SROs, rate the claims. So this is a graphic created by the FDIC, and it shows a little bit about what goes on in securitization. Originator originates the assets. This goes into a special purpose. This is where the tranching and so forth happens. They issue assets that are generally securities held by a trust. There's a servicer. So the servicer collects payments, transfers them to investors in the security, keeping track of who's in what tranche and so forth. There's also a trustee. We have credit enhancements going here. We have investors. So there's a lot of sort of people involved, right? So there's a lot of jobs. One of the jobs that I'm familiar with is you can bid in for these mortgage servicing rights. So this is one of the things I did as consulting. I calculated the probability of prepayment, and the probability of prepayment dictates how much the servicer will bid. So there's a lot of jobs in there. Participants, I'll let you go through this, but this just describes a little bit of what we went through. Originator, special purpose vehicle, trustee, underwriters who actually sell the security, dealers making a market in it, rating agencies, insurers who might sell credit default swaps or just out and out give a credit guarantee on it. Servicers, investors, households, institutions, governments. Good. So just a key point before we move on is a key point here is isolation. When we do a securitization, we are isolating the assets from the originator of the assets. So the originator is not, this process that we're talking about relies on the originator is not liable for payments. This is key in separating the credit rating and the balance sheet of the originator from the security. Transfer of ownership is a true sale. Good. So briefly talk about credit enhancements. So once we have all these assets into a securitization, we can lessen the risk borne by investors by tranching is one. So this this assigns a particular. So what we can say is we can divide up the securitization by, let's say, prepayment. So you can buy a particular tranche, and any payment flows into the first tranche first, and then into the second tranche, and into the third tranche, and so forth. So you can manage, so the idea here is the first tranche would be safe, but have prepayment risk and so forth. So the idea is what this allows you to fundamentally do is take a securitization where, if you just bought the securitization, you would have an average risk return over every asset in that securitization. But if I buy the first tranche by prepayment, then let's say that tranche is 10%, then 90% have to default before I lose anything. So now what I've done is I've created a very safe section of this securitization. Of course, to do that, I have to create a very risky tranche, which would be the last tranche. So you don't get anything for free here. It just allows you to take some sort of an average risk return and create a very safe to very risky tranches. Over collateralization, one of the ways that we can we can make a security safer is we could have issue 100% of claims backed by 110% of assets, right? So, so this means even with some defaults, the security will pay everyone. And we can get third-party guarantees. We can have insurers guarantee risk, guarantee payment for the securitization. So once we have the securitization, we can put in various forms of credit enhancement on it. Is there a downside? All right. So since the financial crisis you've heard about the securitizations during the financial crisis. So, is there a downside here? And really, there isn't a downside to securitization so long as investors can determine the underlying asset credit risk. So, the problem here is, and I don't know if I have this highlighted. I'm going to draw this here. The problem is if the risk is assessed incorrectly, this will cause a misallocation of funds. So the idea is so long as investors can see what's in this securitization and reasonably estimate the probability of defaults, the correlation structure, and so forth, they can understand what's in it, then the securitization shouldn't cause excessive systematic risk. However, what happened particularly in the lead up to the financial crisis is we started creating very complex capital structures. And now the idea here is this, we created a very complex capital structure so the investors couldn't really see what was in it. And if they can't really understand what was in it, well, they shouldn't have bought it. But the idea here is then they can misallocate funds because they might think it's safe, but it's not, and so forth. And this is exacerbated again because of the degrees of separation from the origination and ownership, and then the origination incentive system. So the idea is the originators get just a fee, so they have the originators don't hold it. So if I have an incentive system that just tells them to originate mortgages for a fee, and they know they're going to originate as much as they possibly can, and then when you add on to that the separation, how far they get between the originator and the ultimate investor, these incentives can work off each other to mean ultimately that the originator is trying to originate a lot, but the ultimate investor can't really see what they're doing, and then you get a massive misallocation of funds. Keep in mind, when I talk about the separation of ownership and origination, the originator may originate a mortgage which goes into a mortgage-backed security. It's a securitization, but then that goes into a collateralized debt obligation, which packages that mortgage with auto loans, credit card receivables, and so forth. So, we're getting multiple layers of separation between the ultimate originator and then who's going to own it. So yeah, if the ultimate owner can't really see what's in it, it has a hard time estimating it, and again, the originator has a real incentive to make sure they can't really see what's in it. In some cases, then you can get a misallocation of funds. This is a classic example is what happened in 2008. So if you're interested more in that, you can see this. I linked to it here, Securitization, Lesson Learned, and the Road Ahead. Who's this from? This is Moody. This is IMF. Okay. So you take a look at that. So to an example. All right. So now this example here, this is based off of, the example I'm going to go through is a paper. I'll link to it in the summary. This was an AER paper, Andrew Lowe and others at MIT. So a lot of this research that's going into how to fund cures for cancer is happening out of the MIT Laboratory for Financial Engineering. They also have this Project Cancer X new approach to commercializing biomedical research. So what they're doing here and what we're going to talk about is trying to use securitization to get money into to cancer research. So first, going through a little bit of the problem. In biomedical research, the risks have increased due to underlying factors in the approval process, right? And as these risks have gone up, this has lessened the ability of traditional this is less than the ability for the market to finance research, fundamentally. So what this has led to is what is termed the valley of death in funding biomedical research. An example of, and this is straight from the paper I'll link to, but in 2010, 48 billion was spent on basic research. So when we talk about basic research on molecules that might go into a drug that'll cure cancer, this is a lot at universities and so forth. So they're spending a fair amount of money, 48 billion. However, only 7 billion was spent on translating that into marketable compounds. So this is the really risky stage where it may work. We're going to talk about like a 95% chance it'll fail, but a 5% chance it'll work. So this is where funding sort of dries up for it. But once we get a better idea that it may work, then the funding comes back. So once it's probably going to be marketable, then the pharmaceutical companies will come in, and there's 50. In 2010 there was 52 billion spent on clinical development. So developing that, going through. So what you can see here is the 7 billion is our problem. So what was talked about in some of this research is attempting to make research-backed obligations. So what we're talking about is a securitization not backed by mortgages, but backed by cancer compounds, right? So the idea is you fund a research in a particular cancer compound, a molecule that may cure cancer, or help along the way in some fashion. And so what we're talking about is, instead of funding one of these molecules, funding a bunch of them in a security. So just like instead of funding one mortgages, we're going to package these compounds into a security and sell the security. And if we can get the risk return profile right, then if we can get them to bond-like, if we can create in these research-backed obligations bond-like tranches, then we have access to bond markets, which are huge, trillions of dollars of issuance every year. So, the idea here is if we can use securitization to get part of the securitization funded by bond markets, then, we have access to bond markets, which are huge, much larger than equity. Okay, so understanding biomedical research. And this is just, these are the numbers used in the paper. These are, broad numbers. But the idea here is, any cancer compound here is going to have a 200 million cost at time zero, and then we won't know if it's successful for 10 years. And if it is successful, we'll get 2 billion a year in years 11 through 20. And that's what success looks like, right? So 200 million cost at time zero, 2 billion a year in years 11 through 20. But we don't know if it's going to work, roughly for 10 years. And what failure looks like is we pay 200 million at time zero, and we wait 10 years and it's a failure and we receive no cash flows. So the probability of success is 5%. The probability of failure is 95%. So going back, there's a 5% chance we're going to pay 200 million and then get 2 billion a year. In the years 11 through 20, but a 95% chance that we pay 200 million and we receive nothing. This is for one compound. So as you can see, this is there's a lot of reasons why venture capital has a hard time financing this. One, try telling your investors that you're going to invest in something and then you have to wait 10 years to see if it works out, right? So, and then what we'll talk about here is the risk is substantial. So the idea, if we invest in one cancer compound, then we have an expected return of 11% with a standard deviation of 423, right? So the problem here is 423% standard deviation. This is much too large. The idea is the ratio of expected return over standard deviation is far too low. And again, you have to wait quite a long time. However, if we were to put 150 of these cancer compounds together, then and importantly, we assume the pairwise correlation between the assets, the success of the cancer compounds is zero. This is a big assumption, right? But if we do, then we can get an expected return of 11% with notice the expected return hasn't changed, and a standard deviation of 34%. So here, this is something that we could probably finance. Now the question is, you'd say, okay, well, this is solved, right? The problem with this is, if you look, each asset's 200 million. We have 150 assets, so this is like a 30 billion fund. Now the question that goes through your head is, well, is there 30 billion of cancer research to fund? And no. I've talked to some people in the market, and there's decent stuff, maybe 500 million or, per year, maybe a little bit more, but nothing like 30 billion. You start funding, if you were to start funding more and more, the probability of success would decline substantially. So what I have here is a spreadsheet. So I'm going to link to the paper, and if you, this spreadsheet here that will explain these calculations. So it'll go through from here and calculate the standard deviation expected return of an individual asset and also the portfolio. So if you're interested in those calculations, take a look at the spreadsheet. I also create the capital structure of the securitization, and what I usually do with my students is I have an assignment to add a subordinated debt tranche to the capital structure. So maybe at one point I'll do a video basically going over the capital structure of this research-backed obligation that we talk about here, and then showing how you can add a subordinated tranche to the capital structure. Again, if you're interested in this area, I definitely encourage you to poke around the MIT Laboratory for Financial Engineering, CancerX. These are, they have a lot of working papers. It's really great stuff. Also, as always, the code for this presentation is available on GitHub, and the code for the interactive app there. Have a great afternoon, and I hope you enjoyed this introduction to securitization.